also about the potential contagion risks. The fourth category, complexity, is more or less related to complex products banks are trading, for example, derivatives, but you can also look at, let's say, complex structures within the banking group. In general, we focus on two dimensions of systemic risks. The first one is the cross-sectional dimension. In this dimension, we look at the structure of the financial system and how it responds to or possibly amplifies shocks. Such spillover effects can arise, for example, from common or correlated exposures across financial institutions. But in this regard, also the network structure matters. But before this kind of risk can emerge, there is also a time dimension, which refers to the build-up of risks over time and which interacts heavily with the macroeconomic cycle. So we can see, for example, procyclicality effects. And these effects could, for example, be a shock scenario which could be used for the network analysis. So regarding these things I've presented in these two slides, we will look at indicator-based approaches, which I will introduce you in the presentation, but we will also focus on more sophisticated methodologies, such as network analysis. So, looking at the agenda for today's presentation, we will start with a general description of the network relationships in the banking system. Therefore, we will use some basic indicators which are often used to describe the network structure. And we will look at some basic models which can be used to describe the role of certain types of banks for the network. And we will also have a look, I will also provide you a basic overview of centrality measures often used in this case. In the second section, we look at the network structure and how it relates to contagion risks. In this regard, I will give you a brief overview of some relevant papers which assess the relevance of the structure for contagion risks and how different types of networks react to certain shocks. In the third section, we will focus on the assessment of contagion risks by introducing some models which are more or less basic for different types of contagion channels. And I will also present you some results of our own analysis for the respective contagion channel. Since there is a bunch of different channels, I will focus on, let's say, those channels on which we personally focus the most, which are the credit channel with regard to interbank exposures, indirect contagion through asset fire sales. I will give you an overview of what we call systemic liquidity, which is in addition to the liquidity measures introduced at the microprudential level. Then we will have a look at how shocks could propagate in the network of derivatives trading, with a special focus on CCPs and central clearing. Finally, I will give you an overview of a certain type of model which combines different contagion channels in one model, which could also be enhanced to a lot of other channels. And finally, in the last section, I will give you a brief summary of the results. I will compare the different models I've introduced in section 3. And finally, I will show you some applications on where we use this kind of network analysis for financial stability, for policy with regard to financial stability. So, starting with the first section, which is the network relationship in the banking system. Before showing you some indicators, models, and centrality measures, I will give you a brief overview of the German banking system, which might be helpful in order to understand the results I will present you of our own analysis. So, in generally, the German banking system has a specific structure. It consists of a three-pillar system. The first pillar consists of public saving banks and the respective central institutions, which we call Landesbanken. The second pillar consists of the cooperative banks and their respective central institutions. The third pillar consists of all the other banks, which are primarily private commercial banks. And in this figure on the slide, you can see the interbank exposures between the different pillars of the German banking system. In this regard, you can also distinguish between banks which are systemically important, meaning the DSIBs, the domestic systemically important banks, and other banks. So what you can see on this slide is when we talk about the three pillars, the first pillar consists of the saving banks, as well as some parts of the central institutions. The second pillar consists of the cooperative banks, as well as their central institutions. And the third pillar consists of the DSIBs, which are commercial banks, and all the other banks. Regarding the number of banks, there exists about 400 savings banks. The cooperative banks are about 800. Central institutions, let's say about 10, and the rest of the banking system consists, let's say, about 200 institutions. So this gives you an overview of the number. While the DSIBs are the large institutions, the savings banks and the cooperatives are in generally very small. So, regarding the network of German banks in the German intermarket, what can we observe from this kind of picture? We see that there is a strong connectivity between savings banks and the relevant central institutions, which you can see here and here. So, on the other hand, these central institutions have a strong connection to savings banks and cooperative banks. The reason behind this is that the central institutions act as liquidity centers for the savings and cooperative banks. This means that if, for example, a saving bank has a liquidity surplus, they can provide the liquidity to their central institutions and receive interest. On the other hand, other savings banks, which may have a liquidity deficit, can ask their central institutions to provide them liquidity. So that's one reason behind this large interbank connectivity between the two groups. The same is also relevant for the cooperative banks. On the other hand, we see a strong connectivity between the DSIBs, commercial banks, to all other German banks. Because they are very large and they have interbank relationships to many German banks. We see also a connectivity between the three pillars, so they are not separated in the German interbanking market. And the interbank exposures of the commercial banks would be way larger if we also look at the cross-border interbank exposures. And for this picture, we only looked at the national exposures. So there might be a different view when looking at the cross-border exposures. So, yeah, starting with some indicators to describe this network structure in a different kind of way. As I explained to you, we have a lot of banks in the German banking sector, which are at the end of 2019 1,412, which are considered in our network matrix, and most of them are very small, since they belong to the savings and the cooperative sector. The number of links is a little bit more than 18,000, which shows you that the density of all connections is very low, and even below 1%. So when looking at the matrix of the interbank relations, where you look at lending and borrowing banks, you see that this matrix is very sparse. What we can also see by indicators that the number of net lending banks, meaning that banks which lending exposure is higher than the interbank obligations, is 826. And on the other hand, the number of net borrowing banks is even lower, which means that more banks tend to have a liquidity surplus. The median out and in decree is 9 and 2, which is driven by the large number of small banks. So we can say that the small banks do have interbank obligations only with very few banks, while their exposures are done with a lot more banks. And the medium volume is a little bit more than 100 million euro. And also this medium is driven by small banks. But however, looking solely at this kind of indicators does not give you any information about the structure of the interconnectedness of the interbank network, but also it does not give you any information about the contagion risks. So beside these aggregated indicators, we need to look more on the distribution. On this slide, you can see on the right figure that most of the interbank relations are concentrated on very few banks, while the large bulk of banks only has little interbank claims and interbank obligations. You can also see what we have to some extent saw on the last slide, that the number of connections with regard to interbank obligations is in most cases very low, while we have more diversified relations with regard to interbank obligations. So when describing the structure of the banking system, there exists a bunch of models which you can use to do this. In this regard, I will focus now on the model of Greg and von Peter. This model is done in order to better understand the market structure. They argue that interbank markets are tiered rather than flat, meaning that you have two types of banks. The first one are top-tier banks, which act as money center banks for other banks, and these top-tier banks are connected to all other top-tier banks, so there's a strong connectivity. The lower-tier banks do not lend to each other, and they also only have little relationships to other banks. For example, looking at the German structure, central institutions would therefore be top-tier banks because they act as liquidity centers for the small banks. So the basic idea of their model is to construct a network matrix consisting of these two types of banks, and thereby deciding whether a bank belongs to the core or to the periphery. So in this regard, they argue that in this partial matrix, the relationships within the core are illustrated. So there would be a block of ones. On the other hand, in this partial matrix, the relationships between the periphery banks will be illustrated, and therefore they should consist only of zeros, while the connections between the two groups of banks would consist of some ones, but most of them will be zero because they do not have many connections to the core banks. To illustrate how this model works, I will show you this kind of figure. And in this figure, the nodes A, B, and C belong to the core because they have interbank connections between each of other, and they also have connections to some of the periphery banks. So this is the reason why they belong to the core. On the other hand, all the other banks from D to H belong to the periphery since they are not connected to each other, but they have a connection to at least one of the core banks. So this kind of illustrative figure perfectly fits into the model of Craig and Van Pieter. However, in generally, the real networks do not perfectly fit into this kind of model. So what they do is they define an initial partition and evaluate this kind of partition by moving banks from the core to the periphery. And they decide, according to an error score, if this kind of movement fits the kind of core periphery structure even better. So this is done by looking at the error blocks. For example, in case periphery banks are connected to each other, then this would be an error. On the other hand, if the large banks are not connected to each other, this would also be an error. And finally, the results are the core of the network of the German bank consists only of a 2-digit number of banks, which is robust over time, besides some mergers. So in Germany, it's currently about 42 banks, which they identify as core banks. On the other hand, they also found that the German interbank market fits the core periphery model 8 times better than any random graph. So, looking at centrality measures. Maybe the easiest centrality measure is simply the degree. Looking at this graph here, you can see, for example, that Bank A has a degree of 2 because it has 2 connections. While on the other hand, when only looking at the interbank exposures, which are presented by these directed arrows, Bank 3 only has a degree of 1 because it has only one bank connection with regard to interbank exposures to another bank. The next 2 measures are based on the concept of shortest path. The shortest path is the minimum number of edges the path passes through the different nodes. So the betweenness centrality refers to the share of shortest paths that pass through the node. In this example, Bank 8 has a high centrality because almost all paths from this block to the other block go through node 8. So the centrality of node 8 is the highest. The closeness centrality is the average length of the shortest path between the respective nodes and all other nodes. So the more central a node is, the closer it is to all other nodes. And in this regard, also in this figure, Bank 8 has a high centrality. Going further to other measures of centrality, which are maybe a little bit more sophisticated. For example, the eigenvector centrality. With regard to the eigenvector centrality, a node is assigned to a score based on the concept that connections to other high-scoring nodes contribute more than those to low-scoring nodes. Let me give you an example what that means. In the lower left figure, Bank 1 would have a high centrality because it is connected to all other banks, which you can see from this kind of interbank exposures presented by arrows. So 1 has a high centrality. On the other hand, looking at the right figure in the bottom, one would have no centrality because every other node is not assigned any score. And since the score of the other banks would be 0, then one would also have a 0 score. So the concept of eigenvector centrality does not work for such kind of graphs. Hence, we need to look at the alpha centrality, which adds an external importance to each node. This external importance could be, for example, total assets, risk-weighted assets. It could be the total interbank exposures, or let's say the capital. So when assigning these external importance to each node of 2 to 5, then one would have a centrality measure above 0, and it would be the highest for this whole graph. So this structure works even for this kinds of network structure. And there are several other types of centrality measures, such as the PageRank, which is used by Google in order to assess the importance of websites. Now looking at some additional indicators by distinguishing between the core banks and the periphery banks, which we have identified by the model of Greg and Van Peter. As I told you, the number of banks belonging to the core for the German banking system is quite low compared to the periphery banks. And the bulk of the interbank claims and obligations are concentrated on these core banks. What you can also see is that all the centrality measures I've introduced in the last slide are way higher for the core banks than for the periphery banks, which reflects that the core banks are more connected and more densely connected to all other banks. So, what are the conclusions so far? We have seen that simple network indicators and figures help to describe the network structure. We can identify certain patterns by using models, for example, such as the core periphery structure. Network centrality measures are a tool to identify the most interconnected banks. It could also be helped when it's identifying some systemically important banks with regard to their interconnectedness. However, they only have limited explanatory power with regard to systemic risks. We do not have any information of what a high, let's say, centrality measure means for contagion risk. And therefore, there are lots of open questions, such as, are the most central banks more systemically important? Do the interconnected banks amplify spillover effects, or do they even absorb those effects? And what we also do not know is how do shocks propagate in the interbank network, and which banks are more affected, and which banks contribute the most to these kind of effects. So, based on these questions, we need to go more into the theory and the models. So far, any questions? Okay.
There have not been any questions in the chat yet, so sorry.
Okay. So, looking at the second section where I'll present. Oh, sorry. There was a question. Okay.
Man hört dich nicht, Charlotte.
The question was asked: which software or app package do we use for estimating network parameters? In generally, lots of different software could be used for this kind of network indicators to calculate them and so on. Error could be a possible solution. For example, we use MATLAB because MATLAB has good functions in treating matrices and everything. So this is our choice, what we use, but several other programs could be used to do this. And I think you can also find, in particular with regard to the centrality measures, lots of codes in the internet which you can use for different kind of software. Okay, thank you. If there are not any further questions, I will move forward to the next section. In this section, I will give you a brief overview of some theoretical papers which analyze the impact of the network structure on contagion risks. Looking at this illustrative figure about the network structure, which in this regard represents the structure of the pillar of savings banks, but it would be similar for cooperative banks. In these sections, as I told you, there is a strong connectivity between the central institutions, which are marked as the dark red nodes here, and the savings banks, which are marked by the light red nodes. What we can see that there is a strong connectivity towards and from these central institutions, but there are less connections between the savings banks sector. So what does the specific interbank structure mean for assessing contagion? We do not know from general indicators, so we need to go into theory and into models. So here's a first little overview of the relevant literature. There are two standard literature papers by Allen and Gale and Freshers et al. Allen and Gale modeled financial contagion as an equilibrium phenomenon. They argue that banks have because liquidity preference shocks are imperfectly correlated across regions, banks have to hold international claims in order to diversify their liquidity. The possibility of the contagion depends on the completeness of the structure. Hence, they have shown that complete claim structures are more robust than incomplete structures because the shock is absorbed by lots of banks and not solely by one bank. Freshers et al. Looked also at interbank connections, and they have also shown that they could make the system more resilient to a bank insolvency. On the other hand, they also found that more densely connected banking system could also be prone to speculative gridlocks, even if all banks are solvent. This means that if the market has some doubts on one bank, then they could also face some risks by the other banks. Hence, the whole banking system would be affected. And there are two newer papers which I will focus on the following slides. I will not go too deep into the model, but focus more on the results and the conclusions with regards to the network structure. The first one is Acemoglu et al. He distinguishes between three types of networks. The first one is the ring network, where each bank has a connection to another bank, and their connections with regard to the interbank exposure is different than the one is with a different counterparty than the one with regard to the interbank obligations. We have a complete network where all banks are connected to each other. He also looks at regular banks, which means that the sum of the interbank claims and liabilities are identical across banks, so there is a quite strong assumption. And he also looks at delta-connected networks, which is a kind of theoretical description of a model. And it means that there exists subgroups of banks which are connected to each other, and you can find a value delta such that the connections between the bank is not more than a fraction of this delta. So this is a very theoretical approach to defining a network. So looking at the results, Acemoglu et al. Showed in a small shock regime, which means that the shock is less than a critical threshold. And in this case, the complete network is the most resilient and most stable financial network, which means due to since the network connections are diversified across a lot of banks, this works as a kind of shock absorber. On the other hand, the ring network is the least resilient and least stable financial network, since it acts like, let's say, a domino effect. And he also argued that a combination of the ring and complete network would be the most stable as it increases towards the complete network structure, which is in line with the first result. In case of a large shock, results are even different. The complete network, as well as the rings network, becomes the least stable, because in case of a large shock, this large shock is spread to a lot of banks, and therefore a lot of banks are affected. So the magnitude of the shock really matters. And he showed that this theoretically type of network, the delta-connected network, is strictly more stable and resilient compared to the other ones. So in a latter case, the complete network flips from being the most stable in a small shock regime to the least stable and resilient network in the large shock regime. So therefore, it becomes very fragile in case of a large shock. So the further conclusions of Acemoglu are: dense interconnections can work as shock absorbers in case of a regular network and a complete network, but also as shock accelerators when the magnitude becomes large enough. Benefits of these models are it shows that the structure of a network as well as the magnitude of the shock does matter for understanding systemic risk and the contagion and spillover. And he also shows that there's a crucial link between structure and systemic risk. The limitations are, for us, it is not clear how much can be transferred to the analysis of real networks, since the networks he considers are very theoretical, and real networks do not really correspond to a ring, a complete, or even a delta-connected network. And his results are mainly for extreme cases. So he focuses a lot on the ring as a very poor network with regard to financial stability, and the complete network. And he also ignores from other contagion channels, such as the liquidity channel, since his model only focuses on credit risk. Looking at the second model, the second paper I will focus on, which is by Georg in 2013. He uses two relevant network measures to describe different types of networks. The first one is the average path length, which refers to the path lengths I've described you when looking at the centrality measures. And it is the average length of the shortest path for all pairs of nodes. The clustering coefficients would be given that we have 3 nodes, and I is connected to J is connected to K. So in this case, there would be a clustering if I is also connected to K. So based on this concept, he distinguishes between 3 types of networks. The first one is a pure random network. This random network typically has a small clustering coefficient because all the connections are randomly generated. And since they are also randomly generated, the average path length is very small since there are not many paths. The second type of network is a small world network. Typically for this kind of network is that they have large clustering coefficients. This maybe also reflects that banks in a certain group cooperate with each other. And on the other hand, these type of networks have in generally also small average path lengths. The third type of network is a scale-free network, which typically is logarithmically growing average path lengths, and its degree distribution follows a power law, meaning that some banks are connected to only very few banks, while other banks are connected to lots of banks. The last one, the scale-free network, reflects that larger and more interconnected banks form central hubs in the network, which is also in line with the results of Craig and Van Peter. And this type of interbank network is very typical for lots of real networks, such as in Austria, Brazil, Italy, or even Germany, to some extent. So, looking at the next slide, I've presented you some typically graphs for these 3 types of network structures. And at that point, I will ask you to provide a little guess what would be the most resilient one. And in this regard, I will start a little poll, which you will now hopefully see on the left side, on the right side.
Yes, I can see it. It's open.
Okay. So you will have some minutes to assess or to give a guess which of these 3 types is the most stable with regard to contagion risks. And you can either choose between the random network, the small world network, the scale-free network, but you can also decide to say, well, I don't think that there are significant differences when it comes to contagion risks. So please decide which type of network do you assess to be the most resilient. So while I give you some additional time to do your votes with regard to the poll, I will describe these 3 pictures a little bit more and give you a little bit more about these figures, more information about these figures. So as you can see, the random network has randomly drawn interbank relationships, and there is no real structure and corporations which are reflected in this kind of figure. Compared to this, the small world figure reflects some corporations. For example, looking at these 3 types, or let's say these 3 types of nodes, you can see that they are connected to each other via direct links. So you can assess that, for example, this forms a group which cooperate heavily, but not only within the group banks are connected, but also with different types of other banks. For example, you can see a connection here, here, and here. So you can say that all groups are in some way directed to each other. Finally, on the right side, you can see the scale-free network, which to some extent reflects the structure. You can the core periphery structure, where you can see that we have subcentral nodes like these, and these, which could also be assessed to belong to the core. And we have lots of periphery banks on the outside, which are only connected to one other bank. So these banks may act as a money center bank. But, however, all of the three are randomly generated by assuring that the structure, which I've presented you in the slide before, is considered. So now I see that most of you have provided an answer. So okay, so I will stop the poll now. So I hope you will now see the results of the poll.
Yes, we can now see the results.
Okay, thank you. So most of you assessed that the random network will be the most stable with regard to contagion risks. Some of you said that the small world network will be the most stable, while only one said that the scale-free network is the most stable, and there are no significant differences between the models. So then we will have a further look on the results and see whether you are right or wrong. So, in general, his conclusions are that the network topology impacts the assessment of the long-run stability of the banking system. He finds that there is a topology effect, which is more accentuated in times of crisis. So, in normal times, without any tensions, you are all right, because in this kind of scenario, all of these networks are similarly stable with regard to contagion effects. So in this scenario, you are all right. However, in crisis times, the topology, so the network structure, has a large effect on the contagion risks. And what he found is that the contagion effects are the largest in the random network, and there are less effects in the small world network. And he showed that the scale-free networks, which are typical for some banking sectors, are even the most stable ones in this kind of thing. So this is maybe a little bit surprising when some has a first view of this. And so, but on the other hand, you are the bulk of votes is not completely wrong, because he also showed that the financial contagion effects are non-linear and there exists a tipping point. And moving further above this tipping point, the higher connected networks will become the least stable ones, and since the shocks will spread more rapid. So you are not completely wrong when assessing that a random network will be a stable one. On the other hand, you can see that large, higher connected networks, these tipping points is even higher than for the lower ones. So you can finally conclude and say scale-free networks, which are very densely connected, are stable, But on the other hand, the limit, their tipping point, is very large. But on the other hand, as this tipping point is reached, the contagion effects will spread more rapid than in all other kinds of networks. So there is no general answer, yes or no. It depends on the kind of magnitude of shock. Okay, so far, any questions? Okay. Then I will go further with the next section, which is about the assessment of contagion risks through different channels.
Søren, one
Yes.
moment, please. We have someone put up her hand. It is
Okay.
Vidi Advantma, and maybe she just wants to talk to us. So you could unmute yourself. You are unmuted.
Yeah,
Just
thank you.
Yes.
Am I audible? Am I audible? Can you hear me?
Yeah, it has been a little bit rough, but try again. So.
Okay, can you hear me now? Am I audible?
Yes.
Yes.
Okay, thank you. So yeah, in terms of the crisis, then which one was preferable for central bank to have kind of the interconnectedness type? Because we learned from the global financial crisis, even though the non-financial banking institution doesn't relate it to the financial, doesn't relate to the real sectors, we see how the run is becoming so catastrophic for the economy. So in terms of the central bank, which is we were aware about the financial stability, which type of interconnectedness we prefer to choose?
I think there is no general answer which holds for every type of situation. At first, I think as a central bank, you cannot influence too much how banks react with regard to the interbank market, because it's up to the decision of the individual banks how much they lend to other banks and to which other banks. So what you can do as a central bank, you can monitor how the network structure evolves. And what these papers have shown is that depending on the kind of situation you are in, a different type of network structure could be in some ways optimal. For example, if you assess that there only would be small shocks, then you would say, okay, for example, a scale-free network will be stable. However, you have to clearly monitor that there will be no shock which will be large enough to reach the tipping point, because then the network structure will become unstable. And on the other hand, what I would say would be the better choice is to look at the network models, which I will present you in the following section, to assess how high are the contagion risks. Because all of the papers I've illustrated you and presented you are based on a very theoretically types of network structure, which often do not fit the real network structure. So this could also be, this could only be, let's say, a rough indication how stable a certain structure would be, or a certain real structure would be. So I would prefer to look at different types of contagion models and network models, which I will present you now, in order to assess if your network structure that you see in your banking system is stable or not stable. I hope this answers your question.
Thank you. Very thoughtful.
Okay. So any further questions so far? Okay, then I will move on to the next section, which is about the network models. Yeah. And yeah, as I said, these theoretically networks often do not fully correspond to a real network. So we need network models. And in the following section, I will focus on these 5 types of contagion channels. And I will present you at least one model for each of these type of contagion channel. And several other channels exist, but their impact is often hard to quantify. For example, the reputational channel or other channels such as viral technologically issues or cyber risks or something like this. So most central banks focus on these three types of channels, which is the credit channel, where you can see how credit losses propagate through the network, the asset fire sales, which show some kind of interaction between the funding liquidity, meaning that banks need to have a bank run and they are forced to sell assets, and on the other hand, the market has only limited liquidity. And the funding channel, which is simply shocks modeled by shocks by withdrawal of short-term funds, and how these may propagate between the banks. So starting with the interbank exposure channel, I think one of the standard literature and the basic model is the one of Eisenberg and Noel, which is called the fictitious default algorithm. They show how a macroeconomic shock propagates through the network of banks by credit risk. And they deal with the question, what happens if some banks cannot fully satisfy their obligations? How can then the system be cleared? They assume that there is a seniority structure with regard to the limited liabilities. They argue that outside investors, such as debtors, are paid off first. So banks have the capital and the interbank obligations face the losses. And with regard to the interbank obligations of a defaulting bank, they assume a pro rata allocation of losses, so they do not distinguish between different instruments. How it is applied? At first, a shock is modeled. This shock reduces the capital of banks in the network, and some banks even default, meaning that the capital becomes negative, and then they look how the shock propagates through the network. So let me briefly describe you the main idea in a more mathematical way. The value of a bank is basically defined as the value of its interbank exposures plus its exogenous income minus its liabilities towards other banks. So this is basically the idea of this formula. And what they say that there exists a clearing vector, which means in case the capital of a bank becomes negative, meaning that the value or that the exogenous shock is very very large with a negative, large and negative, then this becomes lower than the outside liabilities. So in this regard, in case the first block is lower than the outside liabilities, the bank is not able to fully provide its payments to its creditor banks. Hence, the creditor banks face losses. So computationally, you can say that this clearing vector is obtained by a fixed point iteration. Why is that the case? It's because the clearing vector of bank I also refers to all other clearing vectors, because we have interbank connectivity between all other banks, and it could be that not only one bank defaults at the same time, but also that there are many defaults. So, okay. beside this very basic model, which always assumes that the capital of a bank becomes negative, which is in most cases or in most defaults, which at least we have seen in the real world, is not the case. We look at another model which is developed by some colleagues, which is the so-called banking system loss. The banking system loss allows to analyze contagion effects due to a deterioration in credit quality. So, beside the special case that the equity becomes negative, this algorithm would also work for, let's say, a downgrade of the rating of a bank. So as a credit event, there could be lots of situations, for example, breaching the minimum required capital ratio, deterioration in the credit quality, or a rating downgrade of a bank, or let's say even more banks. And then the algorithm looks at the adverse effects of the Tier 1 capital and the risk rating assets according to the Basel framework. And finally, after the algorithm terminates, we see how the aggregated Tier 1 capital ratio in the banking system is reduced due to the exogenous shock at the beginning. So the banking system loss measures interconnectedness, and it is the extension to default cascade models because we also see effects even before a bank defaults. So on this slide, let me briefly introduce to you how this model works. So we start with Bank 1, and in this illustration, Bank 1 defaults in the first step, k equals 1. Bank 2 and 3 are connected to Bank 1, which you can see by these red arrows. So Bank 2 and Bank 3 have to do loan loss provisions in order to account for the failure of Bank 1. So their capital, their Tier 1 capital, is reduced by these provisions. On the other hand, even the risk-weighted assets are increased because of the reduced PD of Bank 1. So these are the kinds of first rounds effect we look at. But on the other hand, this model also works recursively, meaning that we can also assess second or higher round effects. In this example, Bank 4 is connected to Bank 2 and 3, but not directly connected to Bank 1. And since the expected losses, which are deducted from the capital ratio of Bank 2 and Bank 3, leads to a decrease in the Tier 1 ratio, which on the other hand is translated into an increased probability of default of these banks. This also has an impact on Bank 4, which now has to reassess its interbank claims towards Bank 2 and 3, since the PD increased. Hence, for Bank 4, the risk-weighted assets on these exposures will increase, while on the other hand, the expected loss of Bank 4 will also increase. So, in this specific case, even as Bank 4 is not connected to Bank 1, it faces contagion losses by the default of Bank 1, since it is connected to Bank 3 and Bank 2. This is basically how the algorithm works. As we have seen, the change in the capital ratios leads to contagion. The change in Tier 1 capital ratio is translated into an increase of the probability of default, which the relation between the probability and the relation between the change in Tier 1 capital and the PD is in this model assessed by a univariate regression. So we can say, let's say, if the Tier 1 capital ratio drops by 1 percentage point, the probability of default increases by, let's say, 20% or something like this. So this is done by a regression. And then we can estimate the expected losses, which you can see here. So we have the interbank connections related to the multiplied by the change in the probability of default of the other banks, which results by the change in Tier 1 capital ratio. And the LGD, which, for example, can be 45% for unsecured interbank loans. So looking at some applications of this algorithm, in this graph you can see the impact of the default of the typically large institutions. You can see that there are high direct or first order effects and relevant, but compared to the first round effect, lower second round effects. On the other hand, if you assume that a group of regional institutions, for example, savings banks or cooperative banks, let's say 20 or 30, will default at the same time, this could have some first order effects, but the second order effects will be very high in this case. This is in most cases the result because when lots of these small institutions will default, then it could be that also a large institution which they cooperate with can also default, and therefore the large institutions also account for a large volume of contagion risk. What you can... Okay, there's a question. Okay, so the question is, do you have sufficient bank default data to estimate the relationship between Tier 1 ratios and PDs? Which type of regression model do you use? It's a univariate regression. Beside data on bank defaults, we also use additional indicators describing the risk situation of the bank. As default, we also take into account resolution and also some mergers which are induced by a high risk situation. So, for example, if they are not economically induced, but by a certain negative situation from another bank. So, yes. That is what we look at. But in addition, we also look at, let's say, market data referring to the ratings and the PD assessment or CDS. So this could also be used. So we did some benchmark analysis to identify the parameters of the regression. Okay, thank you for the question. Okay, so what this type of figure illustrates is also the too big to fail problem and the too many to fail problem. Regarding to the policy which could be considered to prevent from a failure and the contagion effects from a typically large institutions, there are lots of microprudential instruments which could be used, but on the other hand, there are also macroprudential instruments such as a buffer for systemically important banks. For the group of regional institutions, this is a type of problem you may have to assess by a macroprudential policy. For example, you could consider a systemic risk buffer or something to avoid this kind of negative impacts from a group of regional institutions. But I think it's also the task for the financial stability departments to look at these second type of contagion risks. Another application of the banking system loss would be to monitor the contagion risks in the system. In this example, we look at how the banking system loss, meaning the contagion risks, evolve over time by looking at the scenario of an individual bank default of all institutions within the banking sector. And by this graph, you can also see what are the drivers of the contagion measured by banking system loss. And what you can see here, for example, is one driver is the volume of interbank loans. You can see that the banking system loss and the development of the banking system loss, as well as the development of the interbank claims, is highly correlated between 2008 and 2014. On the other hand, you see a second driver, which is the Tier 1 capital. Since the Tier 1 capital increased a lot since 2008, since the financial crisis, also the banking system loss went down. A third driver could also be the density of the interbank market, but this is maybe not a direct, but more or less an indirect driver. Since the density accounts for, since a higher density would account for a higher interconnectivity between the banks, and since this is correlated with an increase in the interbank loans, the increase in density could also contribute to a reduction of the banking system loss. Another application is we can benchmark with other measures of interconnect. We can benchmark the results of the banking system loss with other measures of interconnectedness. What we see here, that we have a low correlation between the banking system loss and the score for the national systemically important banks. And this is even the case for the partial score with regard to the interconnectedness. The difference maybe results since the indicators for interconnectedness only look at the first round effects, meaning the interbank exposures and liabilities, but it does not account for second round effects. So what are the merits? We have small shocks where we can use it. It is easily to interpret. And it supports the evaluation of macroprudential instruments, which we have seen in the slide before. The limitations of these models are it ignores the impact from other relevant contagion channels, such as the liquidity channel. So we look at the next type of contagion measures, which is asset fire sales. Asset fire sales start when a bank breaches the regulatory minimum capital ratio, but it has not yet defaulted, so its equity is positive. Then we assume that it tries to restore its required capital level through the sales of assets with a risk rate above 0. So then we assume that all these assets are marked by, evaluated by market prices. And since this disposal of assets may have an impact on market prices, in particular if there's a high volume, then this may affect also the prices of other banks which have the same type of assets and which mark them by mark-to-market value. And this is a kind of indirect contagion which also may cause additional bank defaults due to mark-to-market losses. Assumptions are asset fire sales depress the market prices of these assets, and banks are subject to capital constraints and mark the assets mark-to-market value. So yeah, what we can here on this see on this slide is a kind of how this could be modeled. So we look at the impact on the capital ratio of the losses and we deduct the sales of assets corresponding to the current market prices from the risk-weighted assets. So in case we sell assets, then these assets have a risk rate above 0, so the denominator is decreased. On the other hand, also the numerator is decreased by the mark-to-market losses, which are LI. And all other banks having the same types of assets, K, are also facing mark-to-market losses by the reduced price. That is more or less the idea. So, going to the next type of contagion channel, which is systemic liquidity. Systemic liquidity refers to effects also induced by asset fire sales. But let me first start with the liquidity coverage ratio, which is a microprudential view of individual banks. With regard to the LCR, we look at the stress scenario of 30 days, and we compare the available liquid assets with the net cash outflows over a period of 30 days, considering also haircuts of certain types of liquid assets. However, those indicators might be too optimistic in terms of systemic liquidity because they do not account for fire sales. And that is what we do with this type of model. We introduce the systemic liquidity buffer as a macroprudential perspective. And this buffer has the potential to indicate vulnerabilities in the banking system caused by excessive short-term borrowing. So the model, which is currently being finalized, is based on the following assumptions and ideas. We assume that banks withdraw cash and do not roll over credit over a certain period. Fire sales prices are determined by a game theoretic approach, meaning that banks do account of the reaction of other banks. The haircuts are based by a stress scenario defined by the bank supervisors, and we use the data derived from the regulatory reporting of the LCR. The systemic liquidity buffer is then defined as the cash equivalence plus the stock of securities measured securities, but in contrast to the LCR, we use these securities measured at fire sale prices. And minus the outflows of liabilities. The SLB can be calculated at the bank level, but also aggregated of the whole system to account for the systemic liquidity in the system. Beside this indicator, you can also look at the systemic liquidity shortfall, the SLS. This one indicates the liquidity risk. For each bank, it looks if the systemic liquidity buffer is negative, then these values are aggregated all over the banks. So, banks make decisions about the timing and the quantity of sales of securities. We look at the stress horizon, for example, 5 days or 30 days, this could be varied. But at any time, banks have to ensure that they stay liquid, meaning that they have enough liquid assets to cover the outflows. On the other hand, banks try to minimize losses in securities market by taking into account its own strategy, as well as the strategy of other banks, as well as the market prices. So the model distinguishes between 4 types of bank strategies, which each bank has to decide on its own in the simulation. And those strategies differ with regard to the date on which the banks sell these securities. For example, small banks which only sell a small amount of securities in a stress period do sell in many cases the securities in period 1. On the other hand, large banks, which have to sell a large volume of securities, may choose different strategies. For example, they may decide to smooth all the securities, the selling of securities over the whole period of time. So they act more cautiously. For example, with regard to the strategies I've presented here, they decide to use the just-in-time or the smoothing strategy. So let me move further to the results. Yeah, what we see here on this graph is that the SLB has the potential to signal systemic liquidity crisis even a little bit before the crisis, because it can show you that there is excessive short-term borrowing, for example, which we have seen here prior to the crisis. So this increase in short-term borrowing has a twofold effect on the SLB. On one hand, outflows are deducted from the SLB, and these could be higher in case of the of a large amount of short-term borrowing. On the other hand, since if in case of many banks having excessive short-term borrowing, then the fire sales prices will decrease. And what we also have seen is that the liquid assets in such kind of stress scenario would not always be high enough to cover all outflows, as we have seen prior to the crisis. We can also compare the microprudential excess liquidity measured by the LCR compared to the SLB of our model. And we see main differences. In most cases, the systemic liquidity buffer is lower, which accounts on one hand for the asset higher bail prices, and on the other hand, one driver are sovereign bonds. Because sovereign bonds are treated preferentially in the LCR, in our model, those sovereign bonds have a higher haircut, which is in some cases, in some simulations, up to 30%. And you can also compare the results between different parts of the banking sector, and you can see that in some cases, in a very large stress scenario, there could also be a liquidity shortfall for some banks, while most of the banks have a high liquidity buffer. Okay, so the next channel would be contagion through derivatives and central clearing. Basically, we have to decide between bilateral clearing and central clearing. With regard to bilateral clearing, which was predominantly brought before the financial crisis, banks which are heavily engaged in trading derivatives have connections to lots of other banks, which are illustrated here on the left side. Since the crisis, oh, okay, there's a question. 1 second. The question is, how do you assess the fire sale value for your liquidity signal indicator? We use the Amihud ratio, which is introduced by Amihud, and the Amihud ratio is assessed by certain market data referring to a crisis some years ago, where you have seen that the market prices of certain assets dropped very high. So the measurement would be the Amihud ratio. I hope this answers your question. Okay, I hope this. Okay, thank you. Okay, and in the aftermath of the crisis, the central counterparties have been established, now they act as intermediaries between the individual derivatives dealers, which now have to be connected to the CCP as clearing members. To become a clearing member, banks have to fulfill certain criteria. For example, they must have a sound solvency. They have to provide margins to account for market losses of derivatives. And they have to provide equity to a default fund in order to stabilize the CCP in case of an extreme scenario, such as the default of one or two clearing members. Oops. So looking now at the different contagion channels with regard to derivatives clearing. Assume that clearing member A defaults. The CCP has to ensure that all of the obligations to the derivatives are fulfilled. And then it relies on the so-called default waterfall. What is the default waterfall? So, in case of a default and in case of losses due to default of Bank A, the CCP can use different sources of capital in order to absorb these losses. The first one would be the initial margins of the defaulting member A. Then they can use the default fund contributions of this member. Since it defaults, it is no longer necessary for the situation afterwards. Then also the CCP can skin in the game by using its own resources and equity. Then banks can also contribute by using their default fund contributions of all the other members. So their contributions are also used to absorb losses of Bank A. And the CCP can also ask additional resources by all the other members, B, D, C, and E. So focusing more on this default fund contagion. In this example, we assume that Bank A defaults. So a large share of the default fund has to be used in order to absorb the losses of the derivatives due to the default of A. So B, C, and D are facing losses which affect their profit and loss negatively. On the other hand, in the aftermath of these crisis situations, they have to restock the default fund in order that the default fund is functioning properly, meaning that in case of a further default, there is enough equity available to absorb the losses. So, since these since the restocking of the volume of the default fund reduces the capital of Bank C, for example, or also Bank B and D, this has an effect on the profit and loss, so they are facing losses. And on the other hand, it also affects the bank's risk-weighted assets, since these default fund contributions are risk-weighted. Furthermore, the restocking of the default fund also consumes liquidity, which on the other hand reduces the liquidity coverage ratio of the banks. So, what we can see here is beside the credit channel or the equity channel where the banks are facing losses, you also have to look which type of capital or collateral they provide to the CCP. On the one hand, they have to provide equity to the default fund, which reduces their liquid assets in case they provide, for example, sovereign bonds or something like this. And on the other hand, to cover the initial margins, they also have to provide collateral, which means, for example, this could be also sovereign bonds, central bank reserves, or cash or anything. And this reduces the liquid assets the stock of liquid assets of banks B, C, and D. And hence the liquidity coverage ratio is reduced or could be reduced a lot in case of high margin calls. And there's even a third channel with regard to derivatives clearing, since a large number of small banks, for example, in Germany, this could be the savings bank or cooperative banks, are not directly connected to a CCP, but there are clearing members, which could, for example, be the central institutions, which do the clearing on behalf of their clients. Hence, in case of high margin calls, the general clearing members may ask the clients to provide more securities in order to fulfill the margin calls. And what we also have seen is that clearing members tend to impose more margin calls as they face by the CCP. And currently a field of investigation is in how far would the general clearing members ask the clients to provide higher securities in case of a shock, which results in high margin calls. So some conclusions with regard to the derivatives clearing contagion channel. What we have seen is that the equity channel, meaning that losses and restockings of the default fund contributions, appears to be less severe because the volume is not very high compared to the capital of the banks. What we have seen is that the liquidity channel can play a crucial role. For example, in case of large margin calls, which we have seen during the Corona pandemic or during the Brexit announcement. And for example, during the Corona pandemic, we saw that the initial margins have increased by approximately 80%. However, to some extent, the central bank liquidity provision has elevated the adverse effects. And what we also see is that CCPs, on the one hand, contribute to financial stability, since they take into account volatility by asking for margin calls and default waterfall as a stabilization mechanism. But on the other hand, the systemic importance increases since they are a critical node in the derivative infrastructure. So the last model is simply a model which combines different types of other models I've presented you. It starts with a credit risk model, considering sectoral risks. Then we use a fictitious default algorithm, which accounts for the credit channel, an asset fire sale, which was introduced by Cifuentes, Ferrucci, and Shin, which I've presented you. And finally, the model is enhanced by an iterative process to determine macroprudential capital requirements. So I think we can skip this slide. The new part of this model is the iterative process to determine macroprudential capital requirements. So we do 1 million times of simulations and calculate the losses for each bank and look at the second round effects by the credit channel and the asset fire sale model. And after each simulation, we calculate the risk contribution of each individual banks, which gives us a distribution of losses all over the banks. By looking at the risk contribution of individual banks to the whole losses of the banking system, we can reallocate the capital in the banking system proportional to its individual bank risk contributions. By these new capital requirements and these new capital levels for each bank, we can start this simulation again. And finally, we can look at the losses for each simulation and assess whether they are now better or worse than before. And we do this a bunch of times until the changes in the capital gets negligible. So what we then have is a kind of theoretically level of the capital in the system, which is in some way optimal from a systemically point of view. So what are the merits of this model? Since it is a simulation which could be done a lot of times, we can estimate the likelihood of systemic events, such as the probability of systemic bank defaults. It takes into account different sources of interconnectedness, such as the correlations through common exposures, which is done by the credit risk model, which provides you with a shock. We can see direct contagion effects through the network of interbank liabilities modeled by the fictitious default algorithm, and indirect contagion through asset fire sales. And finally, the last part of the model can be used to estimate macroprudential capital requirements, which take into account the resilience of the whole system, since the capital is reshuffled according to the individual risk contribution. And it takes into account the interconnectedness and contagion among the banks. So, questions so far? Okay. Then I will provide you a brief summary of what we have seen during this presentation. At first, here's a little comparison between the different models I have introduced to you in section 3. What we can see that many models focus on the credit risk and credit channel, for example, the fictitious default, the bank system loss, as well as the combined network model. Market risk is also addressed by lots of models, for example, the asset fire sale, the systemic liquidity buffer, and the combined model. And to some extent in the bank system loss, since it accounts for provisions which affect the risk-weighted assets, and in the model for derivatives clearing due to the margins which are considered. Liquidity risk is also addressed by the systemic liquidity and due to the margins in the model for derivatives clearing. Some models also take into account the impact on the risk-weighted assets, beside the impact on other ratios such as the LCR or the capital ratio. In some models, there is a breakdown of instruments. This is particularly the case in models which take into account asset fire sales, such as the asset fire sales of Cifuentes, the systemic liquidity buffer, as well as the combined network model. Looking at the regulatory measures they focus on, you can see that most of the models focus on risk-weighted capital ratios. Two models could also be used to assess the impact of the leverage ratio, which are the banking system loss and the combined network model. In the basic type, the leverage ratio is not considered, but they could be enhanced to also consider the leverage ratio, for example, as a binding constraint with regard to bank defaults. The liquidity coverage ratio is used when assessing the impact of asset fire sales, as well as in the models for derivatives and clearing with regard to the provision of securities, for example, to the default fund or to cover margin call needs. In the model for derivatives, also the other measures could be considered with regard to CCPs. And three models introduced further measures, for example, the banking system loss, which enhances cascade models, the systemic liquidity buffer, as well as the systemic liquidity shortfall. And the combined network model introduced the so-called macroprudential capital requirements, which is a certain capital allocation which is optimal from a theoretical kind of way. So finally, there are two additional applications which could be considered for use of these network models. The first one in the context of stress testing. So you can use the results of the stress test as an input for contagion models such as the banking system risk to also account for second round effects. A second application would be to use network analysis in the context of a loss absorbing tool. This is a kind of tool which we use, for example, for monitoring the risk related to the corona pandemic situation. In this regard, we start with looking at available capital resources, also considering regulatory and supervisory measures which were available during the current crisis. Then we look at the first round effects, which is in some way a kind of stress test. In this regard, we look at loan loss. In the second step, we look at loan loss provisions, the impact of stress on the risk-weighted assets, and how they reduce the capital ratios. Channels which are considered are, for example, credit risk, market risk, risk related to derivatives, as well as the impact of drawing of credit lines during the pandemic situation. In the third round, we look at the deleveraging. So we assume that banks try to restore capital ratios by restricting their lending or by not rolling over short-term assets. The fourth one is then the network model, which could be, for example, a network model like the banking system loss, covering risk via the credit channel, but it could also be a model, network model, considering the impact on the liquidity risks, such as the SLB. And finally, we look at the effects on lending capacity, which means that due bank defaults and capital depletion, bank may stop lending or decrease lending to real economy. However, we also assume that other banks are able to substitute in case of limited lending of other banks, which are restricted, for example, by minimum capital requirements. So we take into account both effects. So finally, a summary. What have we learned from this presentation? We have seen methods which allow for evaluation of the likelihood of systemic events in the banking system in case of a shock. Such systemic events could be simultaneous bank defaults. We can also use models to separate different types of contagion channels or to use different models for different contagion channels. We can use the models to monitor and assess contagion and spillover risks in the financial system. We can apply these models to scenario analysis, stress tests, and loss absorbing tools, since it is an additional tool to quantify second round effects. We can use them to calibrate or to use them as a benchmark for the calibration of capital requirements, taking into account contagion risks, for example, with regard to the buffer for systemically important banks. We can also, besides the calibration of the capital requirements, we can also use them for the evaluation of those instruments. We can assess the systemic implications in case of a bank default. So this would be an idiosyncratic shock or something like this. Yes, so far. So thank you for all your questions and for listening to the presentation. I hope you enjoyed it. Do you have any further questions? So there was a question.
Right.
So the question is, do you account for shocks coming from foreign banks? If yes, what assumptions do you use to trigger defaults for the foreign banks? Our network analysis focuses on the impact for national banks due to data limitations with regard to the connections from foreign banks. However, in case of a certain situation, for example, a crisis in another country, we also look at the cross-border claims towards the respective banks in these countries in order to use them as a shock for our network models. But on the other hand, as I said, due to data limitations, we can only model the shocks, how the shocks propagate within the national banking system. So foreign banks could also only be used as a trigger for some events, but we cannot assess how these contagion propagates from national banks back towards foreign banks. This is what we cannot assess. Any further questions?
I don't think there are any further questions. So, Søren, thank you so much for this long presentation. It was really interesting. I hope it was useful for the participants. Thank you for all the to all of the participants for staying with us so long. We took a little overtime today. But I really hope you enjoyed it. I would like to remind you that next week we will be talking about in the Kings. I know that the patient is just being updated, and yes, you can get the PDF material of this presentation after the course. We will send it around. And for those who can't get enough of financial stability and the Bundesbank, I would also like to announce that we will have a full course, an internet, like a 1 week course, which will be held in January, in the last week of January. So please keep updated on our website, and you will find in due course our new courses. Thank you, Søren, so much for this presentation. I hope everyone will have a very good weekend, and I will say goodbye. Bye-bye.